Listen, folks. We are in listen, this is how to pay off mortgages in an average of 7 to 9 years. And today's subject matter, Credit Goddess, are you ready? Are you ready, Credit Goddess?
I am ready.
Okay, because see, listen, we're talking about credit cards and debit cards, and we're going to be telling folks which one is good and which one is bad, which one is evil. The credit cards are the debit cards. And let me tell you what I think. And then we'll let you say something about it, Credit Goddess. We got 49 people in here right now, but it's only one share. Please, this is information people are going to want to hear. Please share the room. This is a hot topic. Credit cards are good. Debit cards are bad. Credit Goddess, tell us who you are and what makes you an expert on this subject.
Hey, hey, everybody. Happy Sunday. My name is Rosalore Lewis, also known as Credit Goddess. I help my clients improve their credit so that way they can gain access to other people's money. What we say, always approved, never denied. I'm a credit score improvement strategist. So not only do I help you repair, but I also help you rebuild your credit to that A1 credit. Also, I'm a business credit consultant. A lot of people don't know that you can actually establish business credit under your business without having to supply your social. It does take, a couple of months to actually establish that, but you can separate your personal credit from your business credit. So I do help my clients establish that. And I'm also an educator at B4 University where I teach credit alongside with Flame. So yeah, that's what I do. I've been doing this since 2016. I've helped my friends and family since 2012 when I just picked up a book, read it, implemented it, and I've been maintaining and establishing since 2012 my own personal credit. So I use my same tactics with my clients. More education than just a service because credit is a lifestyle, you guys. So I'm here to talk about it. Let's go.
All right. Miss Donna, come on, tell us who you are and what you're all about today.
I'm Donna. My name is Donna Anglin. I'm a registered nurse out of Canada. I'm a business purpose loan broker, mortgage lender. I'm a real estate investor here in Canada. I also run an assisted living for senior, independent and assisted living for seniors. You can check my bio for anything else. I'm always here to add value wherever possible. This is Donna, and I'm done speaking.
All right. Listen, we're not done yet. We are not done yet because I just saw RB, the realtor from New York. RB, I'm trying to be them like that, have the male version of that, that great radio voice that you have. Could you come talk to us this morning and tell us who you are and how great you are?
Good morning, family. How are you, Don, today?
Excellent, RB. Could you go ahead and introduce yourself, please?
Sure. My name is RB the Realtor. I'm a licensed realtor in the state of New York, a buy and hold investor on the residential multifamily side. That's 4 units and less, and also a landlord operating in the long-term and short-term rental space. But my passion lies in helping people understand how to create generational wealth through the acquisition of real estate. To that end, I have a couple of give backs. The first one is I have partnered up with Chase Bank, and we're doing a string of in-person first time home buyer seminars. The next one is August 11th. And you can click the link in my Instagram bio, NYS_realtor, or either go to rb10k.com to get the details on that. It is free of charge. And then the second thing is next week, well, actually, this upcoming week on Thursday, I do have a networking event where we're going to actually have a few different people speaking, one of which is the president and CEO of the Upper Manhattan Empowerment Zone. We also have people that are in the commercial and development space that'll be talking, as well as myself. But bigger than that, it'll be an opportunity for you to connect with people that are heavy hitters in the real estate industry, business card exchange, shake hands, and create relationships, and hopefully leverage those relationships to increase, scale, or begin your business. It's for entrepreneurs and anyone in the real estate space. So if you're interested in that, you can go to my rb10k.com card and reserve your free admission, or either go to my Instagram, click the link in the bio, and reserve your free admission there. And I'm here to add value wherever I can. Thanks for having me.
All right, RB. Listen, folks, I'd like to start out this conversation with this question. I'd like to start out our conversation here. Why is it good to borrow money? Or is it good to borrow money? Is it good to leverage other people's money? And I'd like to get your ideas on that individually. Just the moderators, come, if you have come on, RB, talk to us.
Well, I think it is good to leverage other people's money if you are putting it into some sort of investment that is going to yield returns where it makes sense. Everything always boils down to how you're able to get revenue, or either get some sort of profit off of what you're doing. So to borrow money and not make money off of the money borrowed doesn't make sense. But if you're able to leverage other people's money, such as the bank, right, and then be able to yield some sort of revenue from that, then that's always a good idea.
Thank you, RB. But I'm talking about specifically, I'm talking about today, credit cards. So if people are using their credit cards as opposed to their debit cards, how is that leveraging to make more money, or to benefit them? Isn't that just sinking them deeper in debt if we're talking about credit cards versus debit cards? Anybody got any thought on that?
I would think that using your credit card is going to add value, basically build your credit. Debit card doesn't do anything for you. It's like using cash. So you want to scale up in business. You want to take and especially being in these rooms, you want to take your personal credit and moving into business credit, or just if you're not even into business. I mean, it's very important that you do have your credit cards and to use them. And, as I said, because I mean, when you're going to go for a car, they're going to look at your credit, you're going to look at your FICO score. And for whatever you need, it's all about credit. And if you don't have those numbers good, I mean, debit card will never give you those numbers, period. So it's best you have your credit card, use them, know how to properly manage your financing, and you can scale up and go anywhere you want to go. Thank you.
All right, RB, you were going to jump back in there, but I wanted to say this before you jump back in, that we're going to actually show some numbers today so that you can actually, I never do any of this without showing the numbers. There's a lot of good information on this app, or on YouTube, or LinkedIn, or however you're are consuming this content. But folks, if people are giving advice without showing you the numbers, I'd be leery of that. It sounds good, but tell me, how much is that going to cost me? How is that going to affect me long term by showing me the numbers? RB, you were going to tap in on the credit card thing. What do you have to say?
I was going to say something similar to what Donna was saying. Basically, you need to build your credibility. So when you are able to build your credibility, you're then able to access different other lines of credit, which can allow you to deploy that money, or that borrowed money, into different assets. So it was similar to what Donna was saying. I see Rose there. Rose, you are the credit goddess. I know you have something to say.
Well, listen, we're saving the good. We're saving the one of the best for last here, because she is all about it. Hey, listen, RB, just one other thing. All right, you sell houses, correct?
Correct. Yes, I do.
All right, and credit is a very important part of selling houses.
Absolutely.
All right, have you ever run into anyone who is totally against credit cards and using credit and have
I have.
virtually no credit score?
Yeah, and that works against them. So when they don't have any credit established, then it makes it more difficult for a bank to basically establish your credibility and therefore give you a loan. So it actually is not a good thing. And I know a lot of people that just out of miseducation don't utilize credit because they don't know that that's something that they will need down the line, and it winds up working against them, and then they have to go to somebody like Rose to figure out how to establish that. So that's a good segue for her.
Yes, I think so. I think so. Credit goddess. Oh my goodness. Tell us who you are and what you do one more time, and then let's get into that thing.
Yes. Hey, everyone. My name is Rose Laura Lewis, also known as Credit Goddess. I've been in the credit space since 2012. I've personally helped friends, family establish good credit and was able to buy properties, start businesses, get access to large lines of credit because they've established credit the same time as I did, 2012. And now I help my clients do the same. I'm a credit score improvement strategist. I like using that word instead of credit repair, because a lot of times we do not need to repair our credit. Sometimes it's just a matter of establishing it. And it's just getting over that hurdle or that fear of going into debt. Credit is not debt, credit is trust. So I help my clients understand, build up your financial resume by showing how trustworthy you are in lending money to. So that's what I do with my clients. I help them on a personal and business side. So that way we can grow and scale our business using other people's money. The bank wants to lend to you, but we just need to establish that credibility within ourselves by building relationships, because that's what it's all about, building that money relationship with these banks and these creditors and these lending institutions. And so that way we can get more opportunities, open up the opportunity. So that's what it's all about. And I'm here to talk about it. Let's go.
All right, let's go. Let's go. So, talk to us about credit cards being good and debit cards being bad. That is our premise today. If you have another idea, please raise your hand. Come to the stage. If you have an idea that this is a correct way to go, raise your hand as well. We want all comers, all ideas on this subject. Please raise your hand. This is a safe space to share your opinion when you do it respectfully. We want your respectful opinion up here on this stage. So please raise your hand if you have something to say on this subject. But credit goddess, why do you think credit cards are good while debit cards are bad?
Well, you know what? Let's keep it simple because I don't want to like go into a rant. But I'll talk about the pros and cons. I'll kind of break that down. Now, debit cards. The pro about a debit card is that it's interest free, and I know you're going to touch on that. It's interest free. There are no annual fees. And it can also help you with budgeting because you're actually budgeting your money, right? And it's convenient and widely accepted. Now, with the cons about it is that it doesn't build your credit. And then you may face possible overdraft fees if you go over your budget or if you go over the funds that you have in your bank account. Is limited to fraud protection, you guys. This is the part that we don't talk about, but that's the con about it. It doesn't protect you from fraud, and I know many of you guys experienced that before. And then the spending limit depends on your checking account balance. You might as well say that's your budget. Now when you're leveraging with a credit card, okay, the pros about it is that it gives you short term financial or financing options. short-term financing option. If you were to ask me, I prefer a credit card or a line of credit over a loan. Okay. And any of you guys that are bootstrapping your business, the credit card gives you that leverage to actually fund that. And that way you don't have to touch your funds, your hard-earned money that you've been saving for months or years. When you have a credit card, it gives you that leverage and that short-term financing option. It can also build your credit history because anything that you're borrowing on credit, it reports to the credit bureaus. So that is how you establish credit history. And then also it gives you cash back rewards. So it actually pays you to use credit. So that's a win-win, you guys. And then also it has a strong fraud protection, unlike the debit cards. Now, the con about the credit card, it danger of overspending, because this is not your hard-earned money, so you're not consciously thinking about what you're swiping. So when you have that extra leverage, you can kind of go over, right? So this is where people overspend because they have it on credit card. There are interest payments. Okay, so whatever you spend, you're going to be charged interest on what you spent. And this is what a lot of people talk about, like, oh, well, why would I pay extra for what I charge? And that's the concept. But Don is going to talk about how you can avoid interest costs. And there are some credit cards that you can get with zero interest for a short period of time, like 12 months, 18 months, 24 months. And sometimes they roll it back. Depending on how long you've been with that company, they'll actually give you that special offer with balance transfers. Okay, and then also it can hurt your credit because of the fact that it's reporting on your credit report. If you have a late payment or if you go into default, it will report and it will sting your credit. So that's the con about it. So I just want to keep it simple for you guys. That's the difference between a debit or a credit card. And if you were to ask me, it's best to have both your capital, okay, and then both the credit cards. Having two gives you the buying power. But what I like about credit is that you can buy now and pay later. And that short-term financing option is great for business owners, is great for those that are on a budget and then don't want to see that extra comma in your bank account, right? So you can put it on your credit card, build credit, and pay back, rinse and repeat. That's
So,
all I have to say.
so what I'm hearing, Credit Goddess, is that you are not saying use one and never use the other. There are times when you want to use the credit. There are times when you want to use your debit card. But is that what I'm hearing? Is that what I'm hearing from you?
Yes. Yes.
Okay,
Yes.
okay. So here's what I've learned over the years. You tell me if I'm right. If you are in the habit of using your debit card at a point of sale, here's what I've heard. Never, ever, 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 never, ever, ever use at your PIN number at a point of sale. Because
Correct.
all right. And can you tell us why you never, so when you're swiping to get those groceries or buy that gasoline, why don't you use your PIN?
That is all part of that fraud protection. When you are using your PIN, that is the level of security. It is like you authorize the payment when you use your PIN, right? So what if you're trying to claim that you didn't make a purchase, the fact that only you and only you should know your PIN number, it doesn't give you that protection if you were indeed of theft, right? So if you put it on credit and you don't use your PIN, you got that level of protection there. But because credit cards don't require you to use a PIN, it's just a swipe. That's where that fraud protection gives you. That's that level of security there. So that's the difference between when you having to use the PIN, you authorize that payment as opposed to if you had used the credit card and just swipe. That's where the level of protection is, because there is no protection when it comes to credit cards. And don't be afraid of what I just said. That's the difference between low level of protection when it comes to debit and high level of protection when it comes to the credit card. I hope that helped. Thanks.
Listen. What I've also heard is that if your debit card has a major credit card logo, like MasterCard or Visa.
Visa,
Okay.
American Express.
All right. So if you have that protection and you know you have that option of using the PIN or using the credit option on your debit card, so that means that you have the protection of the credit card company. When you use your PIN, it's like handing over cash and you have no protection. Correct or not correct?
Correct.
Wow, wow, wow. Why don't more people teach this and help us to understand that when you use your debit card, even if you use your debit card, if somebody, listen, you pay for something with your debit card, and let's say you never receive that. You buy something online and you never receive it, or you pay for a service that is subpar, or a service or a product you never receive, but if you use your PIN number, you just gave away that money. You virtually have no recourse except to go to court. But when you use your credit card, you can call your credit. You can use that credit option with your debit card. You can then go to your card company and say, you know what, I never received my service, and then you're eligible to get that charge back, get that money put back on your card. Am I understanding that correctly?
That is correct.
Wow, wow, wow. I'm telling you, folks, this is some good stuff today. And listen, we're going to get into more of it today. But right now, we have 57 people in here. We have 12 shares. Would you mind doing a huge favor and share the room a few more times? Can we get it to 20 shares? That's only 8 more. Can we get it to 20 shares so more and more people can hear about this? Why credit? You want to use your credit instead of debit. And if you want to see the numbers we're going to be showing here in just a little bit, you want to go to ICE 10K. I'm sorry, ICE10Kvideos.com. That's ICE, the number 10 and the letter K, videos.com. If you're on Clubhouse, you want to listen in on Clubhouse, you want to participate, go ahead and listen in, and then go to our YouTube channel on your secondary device. All right. And then when you get there, click subscribe, would you please? We're trying to grow our YouTube viewership. Click subscribe, watch the videos. We have over 115 videos up on how to pay off mortgages in 7 years and how to understand credit at this level and why it is a good thing. And so listen, folks, I need you to understand one thing about this. You know, there are a lot of there are some gurus out there that are saying credit, never use credit. Cash is king. And I'm here to tell you, I'm going on record, full throated. All right. No equivocation. Cash is not king. Cash is not even prince. Okay. Cash, if that were the case, then the biggest buildings downtown are banks. And banks are the biggest borrowers in your town. They borrow our money. And then they put our money out there to work. They lend that money out. And then they make huge profits with lending that money out. And then they pay us pennies on the dollar for the use of our money. In fact, some banks even charge us a fee for using our money so that they can make a profit. So if banks are the biggest borrowers in town, they're not lending out their cash. They're lending out our cash. They're putting their cash to work to make money babies. Isn't that right, credit goddess? To make money babies. All right. And so you can do the same thing. Why can't we turn this thing around? Why can't we learn how to borrow the bank's money at a discount? You know, I believe in not paying retail for anything. I like getting things on sale. How about borrowing your money at wholesale? Get a big old benefit. We're going to teach you how to get a big old benefit for using your credit card and other debt, using it, and then paying the bank pennies on the dollar. We're going to show you how to pay a lot less interest on your credit cards and on other debt. And we're going to show you today that credit cards are good, while debit cards are used for emergencies. Credit cards are your everyday cards, while debit cards are your emergency cards. And we got Stack Pack on the go ahead.
Hold on.
Go ahead.
Hold on.
Oh, wait a minute.
This is the analogy that I say. Cash is king, but credit is queen. If we play the chess, right? Kings can only move however they want to move, but queens can move diagonally, horizontally, all across the board. It's limitless when you can use credit. Credit gives you that leverage, and you're able to make moves that others cannot. So that's the difference. I say cash is king, but credit is queen. We minimize that word queen, but queen is everything.
Ooh, listen to you, Queen.
Just make that clear.
Are you trying to tell us that the queen is the most powerful piece on the board?
Yes, it is.
Oh my goodness. Oh my goodness. Listen, come on, kings and queens. We just want to make sure we're telling the truth up here today. And I love that analogy because, if you're using credit, you said it's all about trust, right? When you're borrowing somebody else's money, they're trusting you to pay it back. So let me be here to tell you, if you're using credit and you don't have the cash to back it up, don't touch credit.
Don't touch it. Don't play the game. If you don't have it, don't play the game. Period.
Come on. All right. So what we're saying here, folks, so credit is for people who have money. You would say, Don, I thought when you didn't have the money, that's when you're supposed to borrow when you don't have it. No. When you have credit is for people who have the cash to back it up. All right. And I'm going to give you, before we we're going to have Stack introduce himself. And then I'm going to show you somebody famous who uses credit instead of their cash because they have the cash to back it up. Stack, how you doing this morning, sir?
I'm good, Ice. I just came to support my brother. How's everything?
Listen, man, we appreciate you and appreciate your support. Tell us what you do for a living, please, and how you can help others.
I appreciate you, Ice. I own a worldwide digital marketing company by the name of Internet Traffic LLC, and it's attached to a magazine as well. And I help everybody on every single platform grow. So it doesn't matter which platform you're on, TikTok, Facebook, Instagram. I help, people grow. I figure out marketing solutions to get you to the next level. I help thousands of people on and off the app get to the next level, get them in publications, get them in digital billboard placements. So that's the stuff I do, Ice. That's a little bit. Ain't about me, brother. It's about paying off mortgages. So let's talk about this credit, supporting you. Let's get right into it.
Let's get into it, folks. All right, folks, here's what we're going to do. Right now, I need you to focus in on this. If you want to see this video that I'm getting ready to show, then you want to go to ice10kvideos.com. That will take you directly to our YouTube channel, ice10kvideos.com, and then subscribe, like the videos. Even comment on them. That helps to get the message out. And I need you to hear this one thing, because about a little over a month ago, I had the opportunity to work with E.T., the hip hop preacher. All right. Dr. Eric Thomas. And this is what he had to say about his own journey with credit instead of using his cash. Go ahead and play it, please.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, ladies and gentlemen, that was E.T. talking about how, if you've heard him before, if you heard him on YouTube and watched his videos, and you may have heard him talk about the fees that he's able to command, being the number one motivational speaker in the entire world. In fact, I heard him once in Texas when he said that a major corporation, a top 100 company in the world, hired him to come in to do an hour speech, $150,000 an hour. Come on, man. So why is he using a mortgage? Because it's cheaper to borrow the money than to use your cash. When you pay cash for a house, you have to take that cash out of an investment that's making 7, 8, 10, 15%. All right. So if you take your cash out, it can no longer make money for you. What you want to be able to do is borrow your money at a discount. And there's a thing called interest that we want to avoid. If you can avoid interest on borrowing that money, then you can get what's called you can affect the interest rate in your favor. Okay, how do you do that? All right. So when we talk about how we are able to do that, by the time, if you know what to do, by the time you contrast how much interest the bank wants for this loan, and then you look at how much interest you will actually pay, then when you do the math, to borrow the money for your house could come out less than 1%. The effective interest rate could be 1% or less. If you could borrow money at less than 1%, why are you taking your cash out in an investment that's making you money, babies? Why would you take your cash out when you could borrow money so much cheaper? We're going to get into that in just a little bit here. So listen, folks, do we have anybody from the audience that wants to come up and ask a question and put their 2 cents in on this? Please go ahead and raise your hand. But in the meantime, we're going to go over to, I'm going to share my screen right now so that you can see something that you probably have never seen before. We're going to go over several examples here just to give you an idea of what it means to use somebody else's money instead of your own to purchase assets. Okay, so here's what we're talking about. I want.
I
Go
I have
ahead.
a question I have a question in the chat here. I'm
Please.
just in the chat looking. So we have a question here from Jackie. She's unable to come up on stage. She said, no, not Jackie, sorry. Tarsha said, how can you use your credit card or line of credit or HELOC to buy a second car if you already co-sign? She said she's already a co-signer on a car already.
All right. Here's the thing. All right. And, when people ask questions and then the first idea that comes to mind, I'm going to refrain from saying, I'm going to start here. You obviously have a good heart and that you want to help people. And that's a good thing. But in the future, I think everybody on stage would say, don't co-sign, even for relatives. Don't co-sign. That's number one.
Never.
I don't co-sign for my children. I find another way to help them, but I don't co-sign because it affects your ability to do something while they are trying to level up their credit. There's better ways to level up credit than co-signing. Never, ever, 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 ever do it. Now, I'm going to let Credit Goddess tap in here and say, how can you, is there a way to use your credit more fully, even if you've already have co-signed, Credit Goddess? I know it's tough.
You caught me eating. Okay. Now I'm what popped up in my head, I'm not sure if we went on and tried to apply and you got denied, but do keep in mind that if you're trying, like Don just said, you don't want to co-sign because it does affect you in later opportunities if you're trying to borrow. Because what we also have to consider is your debt to income ratio, your DTI, right? So, say for instance, myself and RB, we bought a house together and both of our names are on the home, and it's also reporting on our credit. Let's say $300,000 each. I make a salary of 70,000 and RB makes a salary of 150. I can't, because of the fact that my debt to income ratio, because of my income is at 70,000, we both are on the property for 300,000, and it's also reporting on my credit. If I'm trying to get something else, my income will not be able to sustain additional debts. You know what I'm saying? So that's one reason why you don't want to co-sign, because that debt becomes yours too. And it's also reporting on your credit. So if your husband, wife, is good that you are on a deed, I think that works on a deed instead of you having to co-sign on the loan. You can be on a deed, but don't co-sign on the loan because that debt becomes yours. Now, with your question, Miss Lady that asked, you want to find out with your bank if you can, because again, the consideration is also your income. If you will be able to, or if they will be able to approve you based on that. That's the variable I can't speak on because I don't know what your income is, but just keep that into consideration if you're trying to get approved for a line of credit or even a loan. I hope that helped.
Listen, Credit Goddess, thank you so very much for that, folks. Listen, when I would try to get out of that as soon as possible, get them in a good position, and see if you can get your name off of that. Is there a way? Is there a way to get your name off the loan, Credit Goddess, prior to it being paid off?
What kind of loan? I
Um,
mean, the only way to get off the loan is if you do a refinance
okay,
out of it. Yeah.
okay. So if they're in a good position, if they're in a better position now, all right, then see if you can get yourself refinanced out of that, because it's only supposed to be a temporary solution to a problem, right? Co-signing just temporary, get them to a position and then refinance out of it, and let them stand on their own 2 feet. Correct?
Right. Right. Because
Okay.
the reason why you co-sign is because they couldn't stand alone
Hmm.
with getting approved a loan. So you have to come in with your financials and your credit to make it solid, right? So if that person is not able to keep their obligation, then you're responsible.
You are
That's why
definitely
you don't want to co-sign.
You're
Yeah.
definitely responsible. So let me tell you something, folks. If you are co-signing on something, if you're co-signing on something and the person cannot pay, all right, for some reason they can't pay, they're running late on their payment. Don't ever let it go 30 days, because that's on your name as well. You pay the payment. Pay the payment. You don't want to do it, but pay it so you can protect your credit. Don't let it go 30 days. I'm telling you. All right. There should be a whole bunch of mic flashes on here. Don't let that thing go 30 days. You want to make sure that your situation stays pristine. And so you want to move all the, what is it? The ego out of the way. This is not my bill. I'm not going to pay the bill. Oh yeah. That is your bill. That is your bill, because your name is on it. And if they can't pay it, please pay it. And then as you pay it, you're actually improving their credit situation so that you can refinance out of that so they can stand on their own 2 feet. All right. That's where we are with that. Are there any other questions in the back channel here, in the chat room?
Good
No.
morning. Yes, I do have a question.
Okay.
Um, I am fairly new to the clubhouse, and I had typed it in a chat, but there was so much stuff going on in the chat, so I figured I'd just raise my hand.
Come on, Crystal. Come on with your bad self.
I just recently purchased my first home in January, and you guys giving me this information about like credit cards versus debit cards is really making a lot of sense. This is something that I did not know. Like if it has that Visa or MasterCard logo on it, as far as the option to just use the credit versus the debit portion of it. But my question was geared towards helping like my adult son build his credit. So my credit is fairly decent, and I wanted to add him like as an authorized user to my credit cards. Does that work? Is that something that, because he wouldn't be using it, but I heard that was something I can do to help him boost his credit.
All
So can
right.
I have a little bit more information on that?
Oh, Miss Crystal, you couldn't have come to a better place and asked a better question. It all depends on the goal. If the goal is to increase the credit score, then you're going to do that. But guess what? Credit Goddess and RB will be able to tell you that they know people with 800 credit score that get turned down for loans all the time. Please, somebody jump in here and tell Miss Crystal how that works.
Absolutely. I love this question. Okay, so I'm going to use this analogy. And I know you guys went through this before. So say, for instance, you work at a job, you're making six figures there, and they're looking for, new hires. And they're starting with you guys because guess what? You've built that relationship with that particular company, and they want to get the inside referrals. They want to get the referrals from you looking for someone, right? So your cousin Ray Ray. He can't act right, but he needs a job. And he's a hard worker. But that mouth of his can get him into a lot of trouble, right? So you got him into the company. He got hired because his resume is exceptional, right? But that mouth of his, he can't take authority, right? So now he got in trouble. And guess who they're gonna look at? You, Crystal, because you referred him. So it's the same concept when we're talking about co-signing, when we're talking about an authorized user. Authorized user is in a different case. They're piggybacking off of your hard work. And what will happen on your son's credit report is, say, for instance, how old is your oldest card, Crystal?
My oldest card, I'm actually fairly new to credit. So my oldest card is probably a year old.
Okay. Now, here's what's going to happen. Now, I can speak on this because I've done this personally for my mom and both my sisters. Their credit scores, were impacted differently. My mom had no credit, and I added her on my 4-year-old Capital One back in 2016. I added her on my $10,000 Capital One, and because she had nothing going on her credit, like nothing, her score jumped up 192 points. So she went from like a low 500 to a mid 700 credit score, right? My sister that had two collections, two medical debt, and she had nothing else on her credit, her score jumped up 77 points. Why? Because the two collections that was on there is actually weighing down on her score, that she couldn't get the whole full 192 points like my mom, because those two negative accounts weighed it down. So she only got 77. And my other sister has established credit because she started around the same time I started, when I got everybody at the round table and said, let's build credit together. Everybody didn't start at the same time, but she did. She started like a year and a half later, though. And she had established credit 3 years later. And she only got 33 points because I started before her. So she was able to get all of my 4 years that I had at that time on top of her 2 years or 2.5 years that she's already established. So she only got like 33 points. So what Don said, even though you have an 800 credit score, you can still get denied, because when when we're looking at your resume, your financial resume, and that is the only card that's on there, even though it has years on them, it has age to it, it has a good limit, it has on-time payment history, 100%. Guess what? The credit profile is thin. Look at it like a job resume where you're trying to go for the six-figure position, but your only job was at McDonald's. Are you going to get that six-figure job? No. you don't have enough history. And this is where people get denied, and it says your credit profile is too thin, and or you have no prior history. And it tells you when you get denied, it tells you what is going on. And that's what we need to establish. Credit takes time to build. It's not something that's overnight. You don't, if you just met me, you're not going to trust me just because my name is Credit Goddess. You're going to come into multiple rooms. You're going to listen to me talk. You even going to do a consultation to get to know who I am and if I'm the best fit for you. It's the same concept when it comes to the bank and a financial institution. A lot of times people have this negative connotation to these credit institutions when they get denied because they're going to them looking for money. They're in that need, but you haven't established any type of relationships with any credit institution, and you're piggybacking off of someone. You didn't even establish your own credit. So should you get approved or should you not? Now, with you, Crystal, you having your son piggyback off of you is a great start for him to then start establishing his own credit, because they can tell when you're piggybacking off of someone because it has this code that says AU, authorized user. If they're looking at his resume and they don't see any of his own credit, then depending on where he's trying to go, like, or what he's trying to get approved for, some would say yay, some would say no. Now, the ones that would say yay are the ones that if he's trying to apply for a credit card of his own, yeah, good start. It will put him in a good position to get those top tier credit cards. But if he's trying to get a loan, no, that's not going to be enough. So that's the analogy I like to use. I like to use the concept of relationships so that way you can kind of get it. You can definitely help him establish what with piggybacking off of you, but definitely teach him how to establish his own credit. Because later on down the line, depending on what he wants to do with it, you don't want him to get the short end of the stick because he doesn't have a strong credit profile. So I hope that helps.
Absolutely, absolutely. I just wanted to say for the record, um, he also has Capital One, and that's kind of where I started. I started off with Capital One, and I had my. They only gave me, I believe, like $1,000, and this is some time ago, maybe about 4 years ago or so. I started off with a $500 line of credit, and then we went up to 1,000. And my mistake with Capital One was I paid it I paid like the full thing off, and I didn't know at the time how to play the credit game. So like I had borrowed, I was spending like 200, 100, and I maxed it all the way out at some point, and then I just paid it all the way up. So I had stopped my cycle of building credit with them.
Okay.
But my son, on the other hand, he had gotten Capital One, and I think his line of credit was like $300, $400 or something like that there. So he has that on top of what I have going on, and he's had that since he was 18. He's 22 now. So he is building his credit slowly but surely, but he doesn't have anything else. Like I have, a vehicle, I have my house, I have other things. I think I have a Home Depot card because when I bought my house, I got approved for a line of credit with Home Depot, which I actually, I needed that. So I have different, lines of credit that kind of, is making me trustworthy, where he only has that Capital One.
Okay, I got you. And how old is he now?
He's 22, but I mean, his ultimate goal is to purchase a home. So, I mean, he had to start somewhere. You know what I mean? So,
Right.
I'm trying to help him on my end. Capital One is really all he can do right now. But maybe financing a car in the future, or I don't really know which way to go with this. But he's like the late 600s, like 690, 680. I think his middle score is like 680. But his debt to income ratio is bad. That's the part that we have to, keep
So
the credit score up.
he needs to make more money. Is that what you're
He
saying?
needs to make more money. And that was actually my issue when I purchased also. My credit score was 780. I was like up there, but I didn't make no money. So my mortgage is high because of that.
Okay. So to get your son jump started in his credit, even though he has the Capital One, he needs a minimum of 3 credit cards and 1 installment loan. So get him started with that. Now, sometimes people get stuck here because it's like, okay, so I'm playing this credit game. So what do I need to do? Well, you need to start establishing more relationships. Now, the best way to go for those that are unclear of what to do, when you are building a relationship, whether it's with your bank, or a particular credit card that you want to, establish a relationship with, make sure that, you take your time to research and see if that card is the best fit for you. A lot of times we go the other way around. I want a credit card, but why do you want the credit card though? You don't want to just get a credit card just to get a credit card, because what I've seen in my line of work is that people would get a credit card, say for instance, a store card, and that's not the great way to go. If you don't frequently shop there, because it's only exclusive to that shop, don't get the credit card if you don't shop there frequently. If you do, then great. And if they have a credit card that you can upgrade to, let's say Target, if they have a card that you can upgrade to, that's great, because you, one, frequently shop there, and two, the cards are upgradable. It can go from an exclusive card like Walmart have an exclusive card, and then you can then graduate to an unsecured card and a card that you can use everywhere else. So don't do the shopping, or don't do a shop card or store card. Two, choose a card that best fits your lifestyle. Are you a traveler? Then you want to look into credit cards that have frequent miles, so that way you can then accumulate the points and use that towards your next trip. If you are, if you use credit card to pay your bills and you want to accumulate the cash reward points, so that way you can turn that into cash, put that towards your bill. What I do is I accumulate the cash rewards, turn them into gift cards, and pass them out during Christmas. I don't like shopping. And the best thing I can do is give you some money and you go get your own gift. So that's how I do it. So if whatever card best suits you, you go shop for that, because they need your business. But you want to know what you're going to get in return. If you look at it that way, then you can then choose that card that you know that you're going to use and also benefit from it. So tell him to look for those type of cards. And another thing too, guys, when you get a credit card, because this was my mindset back then, because I was like, I don't want to get into debt, because that's what my mom taught me. You don't ever want to owe nobody. You don't want to go in debt, blah, blah, blah. But once I understood why I needed to establish credit, especially if I want to get into real estate and I want to borrow money, I need to have my financial resume, which is AKA credit report. I have to make it look as though I know how to manage debt. So I have to get into these relationships. And when I went into it, I was like, what am I going to spend? I thought I had to go on a shopping spree and rack up the bill and then show that I can pay it back. But listen, you don't got to do all that. Whatever we're doing with our debit card, and I explained it earlier, the pros and cons of a debit card, it doesn't establish credit. So whatever you use your debit card for, you pay your car insurance, you pay for gas, you buy groceries, you pay your utility bill, you sign up for these subscriptions, right? Use it on a credit card, since it helps you establish a credit, and then you use your debit card or your bank account to pay it back, rinse and repeat, month after month after month. You don't have to try to figure out what to spend. You already spending it with your debit card. The only thing is not helping you establish credit. So if you have a line of credit, you put those charges on there, set it on auto pay, and then budget and know when to pay that back, rinse and repeat. That's what you want to do. So that way we're not going out there overspending on credit and getting ourselves into debt. That fear that we all have hovering over our head about credit. Credit is the ability to buy now and pay later. It's an IOU, right? So set it up that way, and that way you can then build credit, and you can build these limits too based on your spending, right? And then your ability to pay back. That's how you increase that limit. And your son, $300 card, I'm not sure if it's is it a secured or unsecured? Crystal.
Crystal, if you're talking, you're on mute.
I'm sorry, I'm in a hotel. It is unsecured.
Okay, great. And he had that since 18. Now he can get that limit up, but he just has to spend more on it. Now, this is the concept. Say for instance, that $300 limit, this is the limit that you give your son, Crystal, right? Are you going to give him an increase on that $300 allowance that you give him every single month if he's not spending it?
No, I mean, I wouldn't.
Okay. But say for instance, every single month for the past 5 months, you've seen that he was like almost at the limit, like 300. He's spending 250, 290, and you've been seeing this consistently for the past 5 months, and then he comes to you and say, but and he's been paying it too. He's been paying it down. He's been paying it down to $20, right? And he comes to you on a 6 month and say, Mom, I need an extra $1,000. Can you give me an extra $1,000 towards my allowance? You'll give it to him because you saw that he's been spending up to 300, and you've been seeing this consistently. You say, you know what, and his ability to pay back, you say, you know what, let me go ahead and give you that 1,000. Now his allowance went from 300 to now 1,300.
And that makes sense. I
Yeah.
always wondered how that worked as far as
Yeah.
getting approved for more lines of credit. Because when I was educated, and this was only about a year and a half ago, prior to me purchasing my home, someone educated me free of charge just about building credit. And he told me not to ever go over a certain percentage. So that's what I told my son. I said, listen, if they give you 300, you need to be at 20%. Don't ever go over that 20%. And that's how my method was going as well. But there was one time that I did almost max my card out, but I paid it right back in a lump sum. I didn't do the payments. You know what I mean?
Right.
Like, so for example, let's say it was $1,000 and my monthly payments was $50. I wasn't paying it like that. If I spent, $850 on something, that next paycheck, I was paying that whole $850, or maybe $800 and leaving $50 balance on there.
Right. Okay. And I'm gonna answer this one because we want to get the other questions answered. But with that concept, I hear that people say stay under 30%, and then I get the others probably sitting in the audience right now. Well, why would they give me 1,000 and I only can spend $300? You can spend 1,000, you can, but what you don't want to do is that you don't want it to report that you use $1,000. I mean, if you want to, but you don't want to do that consistently, right? This is called hiding your utilization. And to hide your utilization is that you pay that balance down before the cycle closes. Because when the cycle closes, the next important date is the report date, is what they report to the bureaus, and you get a brand new score every single month. So you don't want it to report that you've maxed out the card, right? Now, the creditors can see the activity, but you don't want the scoring system to calculate that you have maxed out the card. That's the reason why they say to not do over 30. But this is advanced talk, because first we got to get through the baby steps, for the people that have that little, the little fear of going into debt. But it's all about knowing how to increase your score, how to maintain your score, and then maximizing the use of that credit card. You can use the max, but don't let it report over 1 to 7%. That's the sweet spot. If you want to optimize and maximize your scores in that category, which is 30%, you don't want it to max out with you using it, and that's how your scores are down. I see this all the time when clients come to me and say, all of a sudden my scores are down and I don't know why. And I look and they're at max with their credit card. So I have to, coach them on what they need to do to maintain their score, keep the low balance, and not having to reflect their credit score. So I hope that helped. Max out the card so that way you can increase your limit. When you increase your limit, you increase your 10% or your 1 to 7%. Example, your 10% of 1,000 is $100. But if you increase the limit to 10,000, your now 10% is 1,000. And we can do a lot with 1,000. If your limit went up to 20%, your now 10% is 2,000. So this, when you stay within that 10%, then you can maximize your score, keep your score at max, just using $2,000 instead of having to only use 200 and not affect your score. So I hope that helped, Crystal.
It did. Thank you so much. I really appreciate your insight.
Credit
You're
goddess,
welcome.
credit goddess. You hit it. Listen, folks, you can't get away without telling people how to get a hold of you. Because you were dropping some gems. How can people get a hold of you? So listen, they can get it on a private level.
Yes, they can. You guys can send your name and email address to the number in my bio. That is 888-557-5778. Send your name and email address there. There will be a link where you can book a consultation with me. Free consultation. I pretty much explain to you what my services are and how I can help. But if you want me to dive deep into your credit situation, I do a credit analysis. It's just like a diagnostic of what's going on with your credit and what we can do to improve it. So go ahead and click that option so that way we can dive deep into your credit situation, because everyone's credit is different. I'm a doctor, credit doctor. So in order for me to tell you what your symptoms are and how we can put this treatment together to improve it, definitely do the private call. It's only $50, you guys. Let's talk, and that way you have a better understanding of what you need to do with your credit. So check my bio, 888-557-5778. Thank you.
Credit Goddess, thank you so very much. We got some other folks here on the stage. We got some new moderators up. But folks, we're at the top of the hour. That means we're going to do a quick reset. We're actually in the Mortgage Syndicate Club this morning, and we have our own club, the P.I.L.L Method Club, and we are talking about how to pay off mortgages and in 7 years. That is our main thrust. But today we're talking about credit cards versus debit cards. Credit cards being good, debit cards are bad. Or there's a time to use credit, there's a time to use credit, and there's a time to use debit. Oh my goodness, we're going to be talking about some things. But Crystal, you said one thing that caught my ear. You said that because of your credit score, you have a high mortgage. What did you mean by that? Are you still there, Crystal? She says she's in a hotel.
Yes, I am here.
Okay. You said something about you having a high mortgage because of your credit score. What did you mean by that? May we ask?
Sure, yes. And this actually happened when I purchased my vehicle also. So my debt to income ratio is terrible. I don't know the exact percentage, but I work for I'm like a county worker. I'm a caseworker, so I don't make a whole lot of money. And I was actually told this from my lender prior to me purchasing my home. You know, you have excellent credit. You established your credit in the amount of time that was pretty much immaculate. Like I fixed my credit in almost a year. But my income was under 50,000. And then with, I have student loans, and I had different things on my, my debt that was kind of overpowering my income. So, and I went through like a first time home buyer program.
Mm-hmm.
Now my down payment was almost nothing. I think I paid $400.
Excellent.
On a home that cost $155,000, but my mortgage is $930. That's with tax included, and my warranties and stuff included. But I feel like if I made more money, I wouldn't be paying that much on a mortgage.
Okay, let me talk to you. When you take a look at the size of the house that you have and compare it with the same size, the same amount of space that you would have to rent, are you under what you would have to pay in rent?
Yes,
okay.
I am.
You should feel good about that.
I have a 4-bedroom. I have a beautiful home. 4-bedroom, 2-bathroom. I have like a Pittsburgh potty in my basement. I am well up under.
Okay, so what would that rent for? What would that rent for? You know, in your area?
In my area, I was paying $1,450 for rent.
You better start praising the Lord for that $900.
You're right. You're right. You're absolutely correct. But see, I'm learning as I go, so I know the next time go round, and I'm trying to put myself in a better position financially, so that when I go and ask for my next loan, I'll have the income to match that credit.
All right, let me tell you something. Let me tell you something right now that most people do not know. And then we're going to get into our other moderators and we'll reset the room. Right now, interest rates are higher than they have been in the most recent past. Okay, 6%, 6.5%. If you have a mortgage, hold on for a second, folks. If you have a mortgage at these higher interest rates, I want to tell you, you're better off at the higher interest rates. If you have a mortgage, if you can afford the payment, you're better off with the higher interest rates than the lower. And I'm not making a mistake here. I show you the numbers. Go back, watch some of my videos, and you will see that the good interest rates are the higher interest rates. The bad interest rates are the lower interest rates. You don't want the lowest interest rate. You want the right interest rate for you. And that's going to be another show. In fact, let's come back on Wednesday. I'm changing Wednesday's topic to this, okay? Higher interest rates, good. Lower interest rates, bad. We're going to be coming back on Wednesday to talk about it. All right. So, Ms. Crystal, I want you to know that if you watch some of my videos, you are in good shape with your higher interest rates, and I can show you the numbers to prove it. Okay.
Yes, sir. I'm going to join Wednesday.
Okay. So, may I ask your interest rate right now?
My interest rate, I believe, is like a 4.3, something like that, 4.2, 4.3.
Okay, because at the time you got that, some people could have gotten like a 3 or a 2.99 or maybe even a 2.8. But I'm telling you, at the time, because you didn't get that, you're in that 2.99. You're in a better financial position in the 4s than you would be in the 2s, and I will show you the numbers.
I appreciate that. What is your name?
My name is Don Daniel. Ice at the top. Ice at the top. And you can.
I see Ice. I needed to know what your name was.
Okay.
I see Ice. I didn't want to call you Ice.
That's okay. You can call me Ice. But if you click on my profile there, you actually can see my name. All right.
Yes,
so listen, what you want to do is go ahead and get this information and then watch some of my videos on YouTube, and then you'll be able to understand interest rates the way we're supposed to understand them. Because we have been sold a bill of goods when it comes to understanding how all of this works. All right. So we got some new people on the stage. Let's see. We got Gregory Robinson here because he buys houses. Great. Talk to us, man. Are you available to share with us this morning? Because he's probably got us on in the background while he's working. Gregory Robinson, you there? All right, come back in when you can. Flame Newton, listen, man, this is right up your alley. We're talking about credit cards being good, debit cards being bad. What's your opinion on that, sir? Flame Newton. Oh my gosh, there we go. Come on, Flame, talk to us.
Wait, where you at? Hold up now. Hey,
turn up.
I gotta find out where we at now. Okay, I see what's going on. Listen, I need you to go to the greenhouse at the top. See that greenhouse at the top? Follow the greenhouse. No, yeah, if you just came in the room, man, follow the greenhouse. Follow it. Just see if you follow it anyway. Oh, it's turned up in here, baby. Y'all know what time it is. Huh? Let me see them nods in the chat. Nods in the chat now. I said nods in the chat. Okay, let me see them number 9s in the chat. Go to the chat, hit that number 9. Matter of fact, man, what city and state you representing, man? What city you representing? What state you represent? Is Texas in the building? Is Texas here? Is Florida in the building? Oh, Chi-Town here for sure. Okay, Callie, I see you, Callie. Is Callie in the building? Turn up, baby, let's go. Hey, Nines in the chat. Hey, Nines in the chat. I said Nines in the chat. Nines in the chat. Hey, Nines in the chat. Nines in the chat. Hey. What's happening? Let's go, baby. What's going on, Mr. Don? Man, Iceman is in the building, man. Did y'all understand, man? We're in the mortgage syndicate, man. You know what's going on, man. This is the P.I.L.L method, man. This is what he's talking about. Buying off that home in 7 years and you guys can't get excited? Come on now. You guys can't get excited? Man, listen, I look all over the internet and I ain't found that yet. Talk to us, Mr. Don. Man, listen, that's why his name is Don Daniel, because he's the Dun Donna. That's right, baby. Man, shout out to everybody that's on stage, man. Donna, I see you. That's my lady there, man. She holds me down each and every Friday. Man, Credit Goddess had me up all night long. Man, hey, listen, Credit Goddess, I'm going to tell you on a public stage, I appreciate you because the work that Credit Goddess did for me yesterday, man, was amazing, right? Hey, look, hold up now. That's why you gotta have that's why you gotta have relationships with people. That's why you gotta have relationships with people. Man, listen, when I look on the stage and I see RB, man, I can't, man, listen, RB is a diamond in the rough, man. She's trying to help you over there with the lunch and learn. Man, Gregory, what's happening, man? What's happening, Gregory? Crystal, hey, I know you got some love in here. Hey, Crystal, if you got some love in this room, listen, hey, if y'all got love out of this room today, let me see the number 9 in the chat, man. Let me see that number 9 in the chat, man. We turned up over here, baby. You know what the time it is, man. By the way, man, this is Flame Newton here, man, with the School of Credit, author of the School of Credit, also known as America's #1 credit educator. Listen, I'm over here today, man. Only thing that we want to talk about and we want to celebrate. I like celebrating Mr. Don, because Mr. Don comes in here each and every week, man, and drops nothing but jewels of stuff that you cannot find. That's why, listen, I'm gonna tell you like this now. If you're not following him, right, you're doing yourself a disservice. Making sure that you're following him as long as everyone that's on stage. With that being said, man, you guys continue to have one of the greatest days of your life. That's right, man. Flame, and I'm done speaking.
Flame. Listen, man, can you do us a quick favor, man, before we get into this example? I'm going to put an example on the screen here about credit versus how we should treat credit cards. Okay, we're going to do that.
That's solid. Thank you, Flame, for waking up the room. Thank you, Flame. Good morning, everyone. Again, we're in the Mortgage Syndicate Cafe, and we are here with Don Daniels and with Credit Goddess, RB, and everyone. Please share the room. Also, just a reminder, the chat is an extension of the room. Please do not allow any kind of pitching in the chat. I do actually monitor the chat, and I do erase what does not work with our room, please. We do have rules in the room. If you have a question, please feel free to ask the question in the chat. If you're not able to come up, I will ask the questions. Likewise, Credit Goddess will monitor and answer them. But raise your hand, coming up, ask your question. Thank you. This is Donna, and I'm done speaking.
Hey, Donna, I got a question for you, Donna.
Yes.
You know, I'm not gonna lie to you. I'm gonna tell y'all straight up, right? I stayed up so late last night that I just kind of woke up not too long ago after I put some stuff in my mouth to wash it out, right? But my eyes, I didn't really take care of my eyes like that. But when I looked at the bottom, and I saw something. I saw some foul language in this room, right? I saw some curse words. I saw some very foul language.
Yeah.
You know what that was, Donna?
Yep. 19 for 75 people in the room. 19 Flame.
That's
no
Donna,
way.
Man, me and Donna go hand in hand. She knew exactly what I was talking about.
No way.
I'm seeing some derogatory language that's in here. The derogatory language is 19 shares. Listen, we're not about to play these games today, man. Give me up to 50 shares, man. There's 19 shares in here, man. Let me get 30 shares in the room, man. Let's go ahead. Let's not play a game. Let's get hey. He told you how to pay off a home in 7 years, a whole home. Like listen, I looked on the internet yesterday. They told me how to pay off a car in 7 years. He talking about a whole house, and that's all he get is 20 shares. Come on, man. That's what we doing. For real. Like, not for real. We gotta have heart to heart. For real, that's what we doing. We got 21 shares in this room. Nah, because you can't be from Texas. Because the people that I know from Texas, they share the room. Don't you come? You said you from Louisiana. Louisiana? Nah. You ain't no way in the world you want to be from Louisiana, because everybody I know from Louisiana, they share the room. That's what I'm talking about. The folks from Louisiana that I know, they share the room. You from Chi-Town? Huh? Nah, I know you ain't from Chi. I know you ain't from Chi. Chi is one of the most givingest places I've ever been. And you telling me that you don't want to share the room? I know, man, you're not from Chi-Town, man. You from Peoria or something, man. Matter of fact, you ain't even from Illinois, man. You might be from South Dakota or something. Man, you can't be. You know what I mean? Listen, we got 28 shares in the room, man. I need to get to 50 shares, man. Quit playing around, man. Let's not play these games, man. Let's not play. How you gonna say you love someone and you ain't gonna share the room with them? Come on, man. That's not even possible. That's not even possible. You know what I mean? You got to making sure that you're sharing the room, right? It's a way that you do it, right? Is you go down to the bottom, you hit the arrow that goes up. It's 32 shares in this room. Let's not play these games. I'm turned up, man. Mr. Don's, he can't wait to come off, but got to get 50 shares, man. Can we get 50 shares in this room? Matter of fact, man, let's call folks out now. This is call out time. If you share the room, put the number 9 in the chat. Period. If you share this room, put the number 9 in the chat. And you know we can see if you share the room or not. That's the easiest thing. Listen, we got 34 shares in here. Listen, I need 16 more shares. Let's play the game. Man, we ain't got all day, man. Listen, this is what we got going on. Listen, the next 30 seconds, man, I need 16 shares. Let's play the game right. Next 30 seconds, I need 16 shares. Let's go. We got 36 shares in this room now. Come on, let's not play this game. Listen, we got 14. Listen, let's play the game right now. We got 14 shares that we need. We got 10 shares that we need. Shout it out, man. Let's go. We got 10 shares that we need. I need them shares, man. We need them shares up, man. Can we get them shares up? Hold on. Can we get them shares up? Can we get them shares up? I see what's going on. I see what's going on. Can we get them shares up? I need you to go to the greenhouse at the top. Can I see them shares, man? Oh man, we got 44 shares in this room. I'm 6 shares away from getting 50. Let's get to the 50 shares, period. Let's get to the 50 shares, period. 50 shares. 44 shares in this room. And we're just gonna stay right here. We 6 shares away. Y'all just gonna quit at the finish line? That's how we're gonna do? Huh? Oh, 48 shares. There we go. Can we get 2 more shares in this room? Can we get 2 more shares in this room? Can we get 2 more shares in this room? Ah, man, that's what I'm talking about. Mr. Don, where you at, Mr. Don? They got them 50 shares up, Mr. Don.
All right.
Man, hey, hold up, man. My thing is right now, man. They got them 50 shares up. They did that. They did that.
They did that.
They did that, Mr. Don.
They did that.
That's right. Hey, listen, man, put them number 9s in the chat, man. Y'all got them 50 shares. Well, Mr. Donna, he ain't. Oh, we're going to turn up anyway, but this is what we do, baby. You know what I mean?
They did that. They did that. All right, Flame. Thank you so much. Thank you so much. Hey, folks, listen, we're going to shift over here. I need you to take a look at the screen. If you want to see this example, if you want to see, somebody asked me to talk about credit cards versus debit cards. I'm going to do you one better. Okay, I'm going to do you one better. I'm going to combine these ideas. I want you to see something that you need to understand when it comes to credit cards and when it comes to credit, when it comes to your interest rate and your interest cost. There's a big difference between interest rate and interest cost. I use credit cards as my primary way of paying for. Do you know, I can't remember the last time I had change in my pocket. Oh my gosh. All right.
Oh, man.
All right. Listen, I don't listen. I use my cards exclusively. I only use credit cards. And so when I said I carry very little cash, sometimes I get embarrassed. So and when I go out of town, and I know I'm going to stay in a hotel, I have to make myself go to the bank to get some cash so I can tip the valet and you got to have some cash to do some tipping, if you're going to valet your car, all that kind of stuff. I got to make myself remember to go get some cash because I use my credit cards all the time. And I'm getting ready to fly out to Dallas for the first time. I got a speaking engagement in September. And guess what? I have over 600,000 points on my business credit cards. So guess who's flying for free using points, first class, him and his wife? Guess who that is? Thank you, business credit. And I was almost a points millionaire. All right. So I'm using those points because I run my business off the credit cards. All right. So I can get the points. You want your credit card company to pay you to pay your bills. Let the credit card companies pay you to pay your bills. Remember that. So let's go ahead. Let's put this on the screen. I want to show you something right now. And listen, I respect a lot of people on this on Clubhouse, and one of them I respect is Grant Cardone. Anybody heard of Grant Cardone? Put a number 2 in the chat if you've heard of Grant Cardone, because Grant Cardone says he has never paid any interest on his credit cards. He has never paid interest on his credit cards. I'm going to show you today that if you are a real estate investor like Grant Cardone and you say you've never paid interest on a credit card, then you don't understand interest cost. You pay attention to interest rate, but not interest cost. Let me go ahead and put something on it. Let's shoot. I need to show you this. I need to show you. I've got a $350,000 mortgage here. All right. And it's at 6%. All right. Because interest rates are a little bit higher. And let me show you something here. Okay. So I'm going to show you something here on let's see, for about $4,200. I got a $4,200 credit card at 30%. 30%. You know, I had to use a high interest rate to make so we could actually understand what's going on. Okay, because if you look at the interest rate, you're going to have a heart attack. All right. Here's what you need to look at. I got $4,200 on this card. It's a brand new card. All right. $4,200. All right. And it's a brand new card. Did you know that all credit cards are amortized over 240 months? If you want to see this example and you're on Clubhouse and you want to see it, go to ice10kvideos.com. That's ice, the number 10, the letter K videos.com. ice10kvideos.com. ice10kvideos.com. All right. Ice, the number 10, the letter K, videos.com. And that'll take you straight to our YouTube channel. And when you get there, click on the one that's live and also subscribe. Okay. So now let's see. I want to show you something right here. All right. And I'm going to start out with asking a few questions. And I'm not going to start out at 30%. I'm going to start out at 7%. I have a brand new credit card that I just received. I put $4,200 on it this month, but I'm going to pay it off next month when I get the bill. How much interest will I pay if I pay off the whole card? Anybody? Put it in the chat or come up on stage. How much interest will I pay on that card if I pay it all off next month? All $4,200. Anybody? Does anybody know? If I have 0% interest, that is so correct. That is correct. That's at 7%. Now, would it change if it's 15%? What if it's 15%? All right. Same scenario, but at 15%. All right. Same scenario. Will I pay interest? All right. How much interest will I pay? Okay, the answer is no. Okay, so 15, so 25%. 25% has to make a difference. Okay, I got a 25% interest rate on $4,200, but I pay it off next week. Will I pay any interest? Oh, no. They keep saying zero. Keep saying so does it really matter if my interest rate is 30%, folks? I got a 30% interest rate. Let me tell you something. Interest payments you skip don't matter. Interest payments skipped don't matter. You can write that one down. Okay. Interest rate skipped don't matter. I'm even writing it down. All right. I'm writing it down. All right. And I invented that. All right. So here's what I want to show you. $4,200. Let me show you the interest that the bank wanted to charge $105 interest on that $4,200. So if you pay off the $4,200 next month, congratulations, you just saved yourself $105. And that's on a 30% card. Let me ask you a question. Let me show you something here. I'm going to go over to this mortgage, $350,000 at 6%. Here's the payment, $2,098.43. Okay. So I got $4,200 that I'm going to pay off. Let me show you something here. I want to show you cumulative principal and cumulative interest for the first year on this mortgage. For the first year on this mortgage, do you see that we would pay this loan down by $4,298.07? Okay. We would pay this mortgage down by $4,298.07. And how much interest does the bank want for the first year? If you are watching this, listen, if you want to see this, you want to get over to and watch it on the videos. You can go to YouTube. You can search P.I.L.L method on Facebook or Twitter or LinkedIn. You need to see this example. Somebody write down, if somebody is watching this, somebody write in the chat $20,883. $20,883. That's how much interest the bank wants in the first year on this mortgage. And I'm focusing in on that $4,200 for a reason. If Grant Cardone, who is a real estate investor, and he uses the bank's money wisely, if he pays off his $4,200 credit card, even if it's at 30%, he saves how much money? $105 that he doesn't pay. What? Come on, Jackie Harris. I see you out there. Purchase property with credit cards. You better learn how to leverage the bank's money. So Grant Cardone would save $105 interest on by paying off that credit card. But let me show you something. If he has this mortgage, if this is just one of the mortgages that he has on some of the one of the properties that he has, $4,200. Now he has multiple multi-family properties. This is just a single family. $4,200. If I prepay the $4,200.98, if I pay that on line one, if I take the same money, I would pay off the credit card and advance this to my loan and not pay the $4,200 over 12 months. You see, if you take a look at the principal payments here, that's how much goes to the loan each month. $350. If you pay all of that at one time instead of over 12 months, guess what? You're paid down to line 12 in just 1 month. Look at how much interest you save. Almost $20,000 in interest if you use that money instead of paying off the credit card and put it on the mortgage. You save 20 grand. So let me ask you, folks. If somebody told you this, would you be willing to pay the credit card company $105 so you can keep from paying your mortgage company 20 grand? Come on, somebody, talk to me. Come up to the stage, talk to me, and let me know or put it in the chat. Would you pay $105 to your credit card company so you can eliminate $20,000 in interest? You don't have to pay the mortgage company. Jackie says yes. Anybody else? Donna, Donna says absolutely, putting fire emojis in here. And I see diamonds, I see fire, I see hearts. Brenda Jackson says yes. She's learning how to leverage people's money and to focus on interest cost instead of interest rates. But Tammy says, yes, I'm still confused. Tammy, can you come to the stage? You can put yes or no. Miss Tammy, if you can come to the stage, can you put yes or you can say no. But if you did, I'd like to go over this with you. She says she can come to the stage because she's a little confused. We're going to talk to her about this. Let's bring her up. Miss Tammy, let me see. There you are. There you are. Invite to speak. Miss Tammy, come on up. All right, Miss Tammy. Could you hold on for just a second? I want to shout out to Jesse Real. Jesse, how are you today? Can you speak to us for just a minute? Because you've been sitting there patiently. Jesse Real, what's up, man? All right, he's probably a little busy. Miss Tammy, how are you this morning? And if you're speaking, you're on mute. So go to that lower right-hand corner and hit that mute button. There you are, Miss Tammy. How are you?
Can you hear me?
Yes, ma'am. Can hear you.
I'm great. How are you?
I'm doing well. You said you're a little confused. Talk to me.
I don't know if I lost you somewhere when you was explaining how you do that, but I just heard you pay, I believe you said $4,200 your mortgage. If your mortgage is $2,900, yeah. So I got a little confused.
All right, let me talk to you. Okay. Now, you are aware that, do you have a mortgage right now?
Yes.
Okay. You are aware that you can put extra money on your mortgage anytime you want, correct?
Absolutely.
But what you may not be aware of is how much interest you save when you do that. Has your bank ever sent you a receipt saying, thank you very much for this extra payment on the mortgage? It's more than we were looking for. And here's how much interest you saved because of that. Have they ever done that?
No.
Okay. Have you ever paid extra on a car loan or a student loan or any other type of loan? Have you ever paid extra on any other type of loan?
No, I haven't paid.
Okay. But you know people who have. So here's what we're talking about.
Yeah.
Okay. So the Matrix has got you. All right. Matrix has got you. So here's what we're talking about. I'm going to go over this and I hope you can hear me okay. Okay. So here's what we're going to talk about.
I can hear you.
All right, great. All right. So here's what I said, that my mortgage payment is $2,098.43. That's my mortgage payment. But over a year's time, on my very first mortgage payment, do you realize out of all of that money, only $348.43 goes to principal?
Yes.
While $1,750 goes to interest. So most of the money goes to interest. So yes. over a year's time, it would add up to $4,298 going to principal in a year. $4,000. Now, and that would mean I would have to give the bank over $20,000 in interest in a year. Let me ask you, Miss Tammy, should it cost $20,883.09 in interest just to pay my mortgage down by $4,200?
No.
No, it shouldn't. So here's my next question. And just pretend you have the money. I am not telling everybody that they need to do this to make it work. I'm just using this as an example. Okay? All right. All right. So I'm going to pay this mortgage down by $4,298.07 in a year. But do I have to do it in 12 months? But if I had it, could I just pay the $4,200 in 1 month? I'm asking, could I pay it in 1 month?
Yes.
All right. So if I paid it in 1 month, that's a year's worth of payments, but I'm paying it in 1 month, correct?
Yes.
So they would have to subtract that from what I owe.
Yes.
When they do, I'm paid down to line 12 on my amortization schedule. I would be at the very same place I would be if I just made my regular mortgage payment every month for 12 months. But guess what? When you pay all of it at one time, you skip all the interest payments between line 2 and line 12. The interest payments you skip don't matter. So if I'm going to pay $4,200 and if I have it, if I pay it all at once, do you know I skip out on paying about $20,000 in interest I don't have to pay the bank?
Okay, that makes sense.
Did you know
So let
that?
me ask you a question.
Go right ahead.
Yes. So you paying that 4,200 additional just 1 month, right?
Just 1 month. That's
And
correct.
you paying your mortgage. You paying your mortgage that month as well.
Yes, right.
Okay, gotcha.
Right. So now when you look at your amortization schedule, your next payment the next month is not on line 2 of your schedule. It will be on line 3 of your schedule.
Okay.
All right. Now, somebody online is saying, we need to call the bank and tell them to pay it to the principal. Now, yes and no. All right. Number one, if you have escrow, you know what escrow means. If you have your taxes and insurance added into your mortgage payment, then the bank takes the escrow part and puts it into a bank account, and they pay your taxes and insurance every year for you. But some people pay their taxes and insurance on their own. They don't have an escrow account. All they're paying is their principal and interest. So if you're only paying principal and interest, when you send that extra money, it can only go to the principal. If you are escrowing, the default for every bank that I know of, that I've ever encountered, the default for extra money is to go into the escrow account. That's why you have to inform them the way they need to be informed. Where do you want your extra money to go? But if you don't have an escrow account, there's only one place for it to go, the principal. All right. I hope that clears that up for everybody. All right. So here's what I'm talking about, folks. The reason why. Yeah, see, the thing is, folks, so I want everybody to know something. All right. When it comes to principal and interest, you borrow principal. And we need to get the terms correct. You borrow principal. The money you borrowed is the principal. When you look at the interest column, you did not borrow that. You did not borrow the interest money. So interest is nothing more than rent on your money. You cannot prepay interest. It is impossible. You can only pay it or save it. When you put extra money on, it is impossible to put it on the interest because they're charging you based on how much money you owe them. Interest is rent on the unpaid balance. So there is no paying extra money, and there is no, do I tell them to put it on the principal or do I tell them to put it on the interest? There is no putting it on the interest. It doesn't exist on any loan. It cannot be done because interest is rent on the unpaid balance. So interest can only be paid or skipped. You cannot prepay it. So I hope everybody sees that. Excellent, folks. All right. So we have some other folks on there that have any other questions. Please, if you have a question or come on up. But here's the point I wanted to make on this. All right. So with Mr. Cardone. All right. Great, Berna. All right. So here's what we're talking about, folks. When it comes to these credit cards or debit cards, okay, you want to understand them and use them correctly. We have been sold a bill of goods on credit cards being bad for one reason. And here's what I believe. And I could be wrong. But if I'm so focused on credit cards being bad and not paying credit card interest, do you know how many people I've talked to that don't pay credit card interest? I talk to people all the time. They are so proud of the fact that they don't pay credit card interest, but they completely miss the fact that it costs them $20,000 in mortgage interest just to pay their mortgage down by $4,200. Flame, I need you to come in here and talk to us about what you have learned over time about credit card companies and how you can make credit work for you instead of you working for the credit. Flame, how can we make credit work for us?
Oh man, listen. First off, let's not overlook the fact what you just said. Like I'm not that guy. What I'm gonna do is I gotta relish on the moment, right, Tammy? This is what we have to do, and that moment is, he said, people get excited because they paid down their mortgage $4,200, but disregarded the fact that they just paid over $20,000 to do so. Man, if that wasn't a mouthful, listen. If we can't get number 9 in the chat for that, man, I don't know what to say. You know what I'm saying? Like for real, right? You get excited about 42 and over 20. Listen, what I can think is tell you is that when you guys are using credit, right? There's only one reason to use credit. I'm telling you just like it is, right? The only purpose in you using credit is to making sure that you're making money off of someone else's money. So you have to always, in your head, I don't care, you have to always think, I got to make money off of someone else's money. That's a fact, number one, right? Number two, that what goes into this, right, is that when you're spending money at any given place or opportunity, right, you got to figure out, am I making money off of it? How am I making money off of it? I gave the example the other day, and I told him, I said, well, my son needs a new controller, right? He needs a new controller for his game. So my thought process is, how can I make money by getting him a new controller? Seems weird, right? But when you think about it, right? If I use when I use my credit card, right? If I use my credit card at a certain place, where is the controller bought at? I can buy a controller at Best Buy, right? And now I've actually lost money by it, or did I? Did you also know that you can use certain credit cards at certain places, such as the Amex Gold, right? And buy a Best Buy gift card at a grocery store, because you get 4 times the points at a grocery store for your purchase. Now you bought the controller with the Best Buy gift card. When you bought the controller with the Best Buy gift card, now you got 4 times the points on a controller that you listen. I don't understand what I'm saying. Like, these are the things that I'm talking about, is learning how to make money off of someone else's money. And that is the ultimate goal here, right? Matter of fact, right now we got 56 shares in the room. We had 52 shares when he started talking, and he dropped the knowledge here. He dropped. Listen, right now, man, let's go to the bottom, hit the share the room. Let's share this room that's in here right now. If you thought Mr. Donis gave you some great information so far, go to the chat to hit the number 9. Only if you think he gave you some great information so far. Because maybe, just maybe you didn't get nothing out of him. But that's hard to believe. But look, go to the 9 and hit the chat.
Hello.
Hey, Miss Carla, how you doing?
Hi, I am thankful. I'm good. I just have a question that maybe, I don't know, maybe it's been answered already. But I'm a teacher and I'm an advocate of acronyms. And P.I.L.L, PIL, usually is an acronym, but you have dots in between it, so I'm not sure what that means. But what does PIL stand for?
All right, I'll tell you. Listen, folks, here's what I want you to do. All right, number one, I want you to, when you have an opportunity, Google PIL method. Google PIL method. All right. And while you're doing that, I'm going to tell you that PIL stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. Once you Google it, you'll be able to find my website, you'll be able to find videos, you'll be able to find my book that's out there. And the reason why I want you to Google PIL method is because of our SEO, our search engine optimization. Because PIL method is so popular, birth control is on page 2. That part. So what I need you to understand is prepayment of principal means when I prepay means I'm paying the bank before my payment is due. Therefore, I control the timing and I control how much interest I pay because I know what's going to happen when I prepay. Isolating the principal amount means how much do I pay and when do I pay it? Paying extra money every month is a waste of money. There's an optimized way to figure out how much you should pay and when. Then the first L is leverage. Now, here's what I want. When I use leverage, I want to use the least amount of effort to get the most amount of benefit. Leverage. So when we figure this whole thing out, what is the least amount of money I can pay to get the greatest amount of interest savings? Now, listen to this. Listen to this, Miss Carla. When we're talking about that, I want people to realize that why you're paying off a loan. Okay. If all of your loans were 0% interest, if all the loans were 0% interest, and Uncle Al just came into the room. I hope he's still in here. Somebody bring Uncle Al up. We can't leave him in the audience. Come on now. So if all of your loans were 0% interest, would there be any benefit to paying your loan off early, Miss Carla?
No, there would not be, because there would be no interest.
Exactly. Then why are all of the financial gurus that are out there, okay? Why are all the financial gurus out there focused on paying off the principal, how fast you can pay off the principal? They're not talking about how to save on the interest. How did they miss that, Miss Carla?
Maybe not in their best interest.
Well, I'm going to tell you, Miss Carla, what I believe is,
or whoever they're working for.
All right. What I believe is this. Most people just don't know. They haven't been taught. They focus because, we accept information that we hear over and over and over again. But when you get your financial advice, especially from these gurus, it sounds good because it's been told over and over again, and it sounds good to your ear because you've heard it before from multiple sources. But no one has ever given you the numbers to back it up. No financial data, no empirical data, nothing that says this is going to be the best way forward for me financially, meaning this is going to cost me the least amount of money that's possible. I'm going to be able to borrow my money at a discount. Do you love discount shopping, Ms. Carla?
I love it.
So you don't like paying retail for stuff?
I do not.
Okay.
Not at all.
So did you know that most people who love discount shopping did not know that they're paying retail for their money when they should be paying wholesale for it? And you have a choice.
I'm learning that right now.
All right. So this is what we're talking about. So when you understand that when you prepay your principal, okay, you are saving interest. And this is why you do that. And I'm going to give you a quick story on this, folks. I had a guy give me a call. He's from Arizona, and he is a sales manager in Arizona, and they sell solar panels. Oh my gosh, he's making money hand over fist. So he's driving down the road one day in his Tesla. Lord have mercy. I mean, the Tesla was driving him down the road. He was talking to me while he's watching that big old screen in his Tesla. Hands off the wheel. Can you imagine that? On the highway. So he says, Don, what I did was I got tired of this debt that I had. I got all this money in the bank. So I took $40,000 out of the bank and put it and paid off my car. And then what I did was I took the $700 I was no longer paying on the car, and I put it on my mortgage every month to put it on mortgage principal every month. So I'm adding $700 to my mortgage payment every month. Miss Carla, have you heard of a strategy like that before?
No. Why would he put it on his mortgage principal and not the interest, or not to pay it down? Okay. No, I haven't heard of a strategy like that.
Well, actually you have, because when you put it on principal, that's how you save on the interest. It can only go to principal to save the interest. And most people think you're putting on the interest. No, actually, you're putting on, because interest is no more than rent on your money. So when you're paying, when you borrow the money, they charge you rent or interest on the unpaid balance. Does that make sense?
Yes.
So if I put that extra money on principal, that means I'm paying down the unpaid balance, which means I pay less rent.
Right.
Or interest. Got it? Okay, good. So you have heard of taking that money that I'm no longer paying on this bill and put it on another bill. That's called the debt snowball. Have you heard of the debt snowball?
Debt snowball? Nope, never heard of that one.
All right, so look it up, folks. So if I'm using a term you're unfamiliar with, please look it up. Debt snowball. It's when I pay off one bill, then I can take that $700 that I'm no longer paying on that car and I can put it on the mortgage. But when you hear it, does it sound like it makes sense? Because I was paying that anyway.
Sure, it does make sense.
Okay, and that's what I told him. I said, that's what the experts are teaching. Why are you calling me? He says, because I saw some of your videos on YouTube, Don, and here's another shameless plug for our YouTube videos. Go to P.I.L.L Method, search P.I.L.L Method on YouTube, and then you'll find a myriad of information there, like over 117. I think we have like 117 of these shows up right now. So anyway, he says, I saw some of your videos, and now I'm wondering if I did the wrong thing. So I asked him, when you paid off your car, how much interest did you save? Miss Carla, I didn't ask him how good it felt to pay it off. I asked him how much interest did he save, because isn't that why we pay off loans?
Yes, to save the money, yes.
Yes. So when I asked him how much interest did he save, guess what he said?
He didn't know.
He didn't know. He did not know. Because we are taught not to know. Okay. And so we did. So we put it into an amortization schedule. And we figured it all out. Okay. He saved $7,700 in interest, which is pretty good money. Okay.
And to think that he didn't even know.
No, and he didn't.
He was saving $7,000.
Exactly. So now he has I'm putting this on my screen here. On you can see it on YouTube. So he had a $700,000 mortgage, okay, 4% interest, okay, and here's his payment. His payment on his $700,000 mortgage, $3,341.91, okay, and it starts out with $1,000 going to principal. And $2,333.33 going to interest. So if he had put that 40 grand on his mortgage, do you think he would have saved $7,000 worth of interest?
Probably no, right? No, he wouldn't have.
No, you know how much he would have saved?
How much?
$86,000 in interest.
What?
He would have knocked off 38 payments he never had to make and saved $86,000 in interest. So when we prepay a loan, you want to know how much interest you're saving, not about the good feelings you get for paying off a debt. See, there's a guy in Tennessee that talks about the good feelings you get for paying off the debt. And he talks about the debt snowball. And I'm saying in my book, I asked the question, how much do you want to pay for your good feelings? And in this case, the guy said, I'm choosing with because it's called an opportunity cost mistake. The opportunity cost has to do with, I have 40 grand. How do I want to use this 40 grand? I can use it to purchase $7,000 worth of interest savings, or I can use it to purchase $86,000 worth of interest savings. But I'll still have two debts.
Okay.
Yeah.
But you can live with that if you have $86,000 you're saving.
Come on, sister. I love it. I love it. I love it. What do you say to that?
You don't have to pay somebody, right?
Miss Carla, you are exactly right. you're going to have to pay interest anyway. You choose which one you want to pay interest to and how much. Because now you have a way to know. So if you want to know, folks, if you want to know, I got 6 minutes left for those who are online. Okay. We're going to go over a little bit over for the folks that are on Clubhouse. But for those who are online, here's what you want to know. How in the world can I know how much interest I'm paying? How can I know how to best save interest on my loans? And here is how you can do that. You can do that with our opportunity cost calculator. And you want to go to the on the top of our screen here, click on the button there, click on the link. It'll take you to my 10K digital card. And on there, you will see get a savings and earnings report. So if you want to know the month, day, and year you're going to be debt free and how much interest you could save, get a savings and earnings report. Okay. So how do you get a savings and earnings report? Just click on that and follow the directions. And once you follow the directions, we will let you into our financial form. Put all of your debt on that form, everything you owe on that form. And I will show you how you can best use your income to pay off your debt in an average of, listen to this, folks, 7 to 9 years. That's your mortgage, that's your student loans, that's your credit cards, that's car loans, that's everything. Not just the mortgage, but everything you owe, you can pay off in 7 to 9 years on average. Some are a little less. Okay, some are a little more. Now we had one guy who's our celebrity endorser who has paid it off in 4 years. That's E.T., the hip hop preacher, Dr. Eric Thomas. We're going to hear from him in just a couple of minutes. So, folks, if you want to know how to do that, then you want to pay off your debt in 7 to 9 years by focusing on leveraging your money. And here's what I need you to know. You don't need more money to get out of debt. You just need to pay less interest. Use your same budget and not having to sacrifice lifestyle. You can still live well. And we're going to show you how to disrupt the bank's timing, which makes it impossible for them to charge you that interest. Therefore, more of your money goes to principal, and that's where you want it to go in the first place. Your money paying off the loan, not going to interest, making somebody else rich. Are you hearing what we're saying this morning, folks? Okay. So, Miss Carla, does that make sense to you?
Yes, it does.
All right, folks.
Yes, it does.
I want to thank
you.
I want to thank everybody for coming. If you're online, we're going to be letting you go in just a minute. But before we let you go, I need to put the book on the screen. It's been a 5-time bestseller on Amazon. A 5-time bestseller on Amazon. That is The P.I.L.L Method, a better way to eliminate debt. Okay, and out of 33 million titles on Amazon, there's only one title that helps you to understand how amortization charges you interest and how to defeat it. It also points out how you can get an opportunity cost calculator so that you can beat the bank's computer with your own computer, saving you interest. Oh my goodness, you want to know all about that. So folks, get the book today, and you can then you'll start to understand how all of this works, and you can share it with your phone, with your family, with your children, with your nieces and nephews. Folks, we need to get this into the hands of the young people so that they can build generational wealth with the money they're no longer paying in interest. So folks, I want to thank you all. If you're online, I want to thank you for being here today. And I want you to, so all of you that are reading the book, some of you have the book already. And I encourage you, once you read the book, if you like it, please go back to Amazon and do what do they call it? A review? Would you review the book for me? All right. And give it the number of stars that you think it's worth. 5-star. Okay. All right. Give it the number of stars that you think it's worth and do a review for me. And if you've read the book and you like the book, go ahead and do that for me. And so, folks, we're going to be back here on Wednesday where we're going to be talking about higher interest rates. The higher interest rates are the best interest rates. The lower interest rates are the worst ones if you are a home buyer or a real estate investor. Oh man, you're going to be thankful for these higher interest rates now. So listen, we're going to hear from Dr. Eric Thomas one more time as we say goodbye to everyone online. But hang out here on Clubhouse because we're not done.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.